my mind. Looks like we're in the click, just living the
What is going on, you guys, and welcome back to another video. Today I'm joined with my father Mark in the flesh.
Live and in person.
Finally, 7 months later.
Wow, it's been a long time, but
We've been resorting to all the Zoom videos and the StreamYard streams, but there's nothing like doing this in person.
Yes.
And it's
really nice to be back in my old stomping grounds here, so it's good.
with a little bit of changes.
Quite a few changes, yeah.
Quite a few changes. Well, hey, today's video, we figured there's not a better time than to talk about market volatility and the swings we've been seeing in the market, because for those that have been following the stock market over the past, what is it, maybe a few months?
A few months or so, yeah.
We started to see this summer volatility come around. And I think really where we're noticing this is in the comment section, as well as even some students in our academy who are talking more or less about how they're feeling during these periods. Maybe they're not approaching the volatility as they should. So we want to come out and just, I guess, speak a little bit about how you can handle these periods. And maybe Mark's the best person to speak of this because you've been through these periods your entire life.
Yeah, I have been through them, and what I've noticed in, like you say, Brandon, in the comments in our Discord chat, is what I would consider to be quite normal drops during volatile times, like 2% or 3%. A lot of newer investors can find that quite unsettling because you maybe have never experienced that. And I think when you begin investing, you probably tend to pay much more attention to the day-to-day. You're checking your accounts more frequently, and it can lead to some unsettling times. So what we want to do today is just sort of put things in perspective as to how, what you can expect, and look back a little bit over history and use that as a guide to what we're going through right now. Scary times, or
are they normal? Are they common? What we should be doing? And like I think you said, the best way, in my opinion, to prepare to handle these times is to come in prepared and to come in and basically study back on history and recognize whether it's normal or something we should be panicking about.
That's a very good point, and I hope that we do educate about what's happened in the past, because that's how you learn. Yeah. Right. They all these disclaimers say, well, history. You can't base results on what happened before, but history rhymes, and so being aware of that is critical, I would say, to long-term investment strategies.
Well, hey, let's dive right on in here, guys. If you haven't already dropped a thumbs up on the video, please take a moment and give us a like. As well, as always, we do have our academy down below. We can tell you more about that at the end of the video. But why don't we start with this slide here up on the page? Very colorful. Dad, why don't you take it away with this?
Sure. Well, I prepared a few slides here just to see what's been happening recently. So this goes back just over the last couple of months. And the bottom line here, I looked at the three major U.S. indices: the Dow Jones Industrial, the S&P 500, and the NASDAQ, which is the NASDAQ is the green line, the CCMP, that's the code that's used there, and the Toronto Stock Exchange in purple. And the bottom line, we can see from the ups and downs there that it has been quite volatile, and all these major indices are in negative territories, as much as almost 5% in the NASDAQ over that time period. A very interesting way to look at the same information is on a weekly gain or loss chart, and I prepared that on the next one here. Now, this is the Toronto Stock Exchange, and the green bars simply show a week where the markets ended up, and the red where they ended down. So the first thing that kind of jumps out at me here is they're back and forth.
Yeah.
There's a lot of ups and downs. If we look on the right-hand scale, we're looking in the sort of 1.25-ish% rate as far as the deepest weekly drop. And of course, these are from Monday to Friday. So there's going to be some bigger drops intra week, but this is how it finished out. Just to compare that to the daily drops. So the next chart here shows narrower bars, red being down, green being up, and this is where we see. It really, to me, puts it in perspective. We're seeing a lot of choppiness out there.
We're seeing it about 50% of the days in this time period.
Approximately, yeah. One day up, next day down, and a few little strings in there. No different on the NASDAQ. We see very, very similar numbers. And finally, on the Dow Jones, you could just put one chart after another. All of these major indices, to me, kind of look the same. The concept is we're in choppy markets now. This is very common during the summer. And as we go now, we're just early into October. So this is nothing new, but if
you're saying that summer is October time?
Summer is October time. Did I say that?
No, I'm just saying. You said we're in the summer, but
Just in October. I don't know.
We're just ending the summer.
We've ended the summer.
Okay.
A few weeks ago, I think, right? September
Nevertheless.
Summertime tends to be choppier for various reasons, which we can talk about in a whole different video.
I actually did a video on that. If you guys want to check that out at the top of this page, I'll link it up.
Link it up there. Last chart I want to show you here is just the VIX, the volatility index. And we're currently, as of the filming today, at 18.45, and you can see some obvious spikes. If we go back, to the credit crisis, it was trading up sort of near 90, and last year when COVID hit, it was spiked up again, to those high levels. So we're nowhere near that for volatility. But if you drew a line across, the average is below 1845 where we're at right now, and so the bottom line, if we look at the data. So the markets have been choppy. We look at the VIX, it's showing a higher level of volatility than you would normally expect to see, but certainly not horribly high at the moment.
Nothing, I would say, crazy. And you mentioned it at the top of the video. There's a lot of comments that come in and say, wow, markets are down big today. And, they're referencing a 2 to 3% drop. But when you compare that to just quite recently during the COVID pandemic, when we saw the COVID crash, which was about a 30+% drop in a very short period of time.
Yeah.
In fact, this was actually the fastest 30% decline that we've ever seen in history.
Yeah.
That is some real volatility there. And that's where, again, if we put up the VIX, you can see where these major spike ups come. Again, to put that in perspective where we are today, a little bit choppy, but nowhere close to that form of volatility. Now, positive on the COVID pandemic was that we ended up recovering out of that extremely fast.
Yeah.
And I think the data here shows that it was about 17 months to double off those lows.
Almost unhealthy in how quick the recovery came. But
booming out pretty darn fast, which I don't think is normal. And again, I think it plays to why we're seeing all these comments is that, maybe these new investors, they've lived through times where the markets have just powered. Let's assume you started investing during the pandemic.
And a lot of people did.
And a lot of people did. Yeah. Right after, you were participating in that very, very fast run-up, and maybe that's what you're becoming accustomed to, that, hey, this is what the markets are, and now these 2% red days, these 3% drops are feeling huge. Well, again, you're looking at a very short time frame and a very, I think, unique time frame if you just started investing in this given year.
If you're an equity investor, you shouldn't be investing in equities unless you understand that part of that path you're on are times like we're going through right now, and worse. But right now we're going through almost normal routine volatility, but you got to go through it before it really sinks in. And so that's what we're experiencing right now.
Yeah, and I have a couple cool stats here that we could look at, again, to put things in perspective. Basically, based on the data we're looking at here, we see a decline in the market of about 10%, and many people would consider this a correction when the stock market is down 10% or more. We see that on average about every 1.8 years. Now, you will hear different points for that, and different people will categorize it all different ways, but basically once or twice a year, you'll get a correction of this level. Looking back to the date here of 1950, we've had a total of 38 declines of 10% or more. And what's important about this, which will hopefully give people a bunch of hope, is that in all cases, 100% of the times, the markets have powered on and made all of those gains back, or all of those losses back, and pushed to higher highs. If we look at a statistic like the S&P going through a significant crash, and here we categorize that by, let's say, 50% or more, let's say losing half of its value, there were basically two time periods where this happened. And this was going back to the 2007, 2008 financial crisis, where the markets dropped somewhere in the range of 50%, and as well the tech bubble pushing into the 2000s, and that was a decline of about 49%.
Important to note, this is the S&P 500.
Yeah.
So in the tech crash, which was my first crash as an investment advisor, and the S&P 500 saw a drop of 50%, but as the name implies, the tech crash, the NASDAQ dropped in the 80% range. And there were companies that did a video recently showing Amazon dropped 95%, and Cisco dropped 95%. Really important to understand right now, and this is sort of part of the bigger portfolio management discussion, I suppose, but when the markets do drop, you typically get a number of the index dropping. Very few portfolios are the index. If you are properly balanced, you shouldn't see a drop to that extent. Again, hopefully providing a little bit of comfort. And if you see the Dow Jones down 3% this week, most portfolios probably are, they're not going to be exactly 3%.
Yeah, I think you'll see actually quite a big range. You'll see the aggressive investors, the ones that are taking on all the risk, well, they're going to be down significantly more than 3%. And the investors that are much more on the conservative side, well, they're not going to feel that full hit. Whether
you have more conservative investments, whether you have a bond component, whether you have some cash on the side, you're going to see that. And so, volatile times, but certainly not scary.
I don't think so. Yeah.
If you were an investor in March of last year, that would border on scary, I would say. When COVID hit, we didn't know what was happening, and things were they were volatile, but volatile down, right? So what we're seeing now, there's a chart that I prepared here, which I think is so telling, and it looks back at the annual returns and contrasts that with the intra-year decline. So this is the S&P 500 going back to 1980. And let's just look at last year as an example. So in 2020, at the end of the year, the markets ended up 16% to the positive. However, they were down as far as 34% intra-year. Now, obviously, that's in March when COVID hit. We saw a big drop there. If we go back a little bit further than that to the big credit crisis that occurred back in 08, 09, in that range. In 2008, we saw the markets drop as much as 49% at some point during the year, and they ended up the year down 38. So that was the big crisis there. Now, 2009 is very interesting. Although the market, the S&P 500, gained 23% at the end of the year, it was down as low as 28% at some point during the year. On average, there is a drop of 14.3% throughout the year. And if you sort of scan back over this chart of the red numbers, you will see anywhere from -2, -3, even -1 more recently, down as far as 49%, or often at some point you're going to see, well, say an average of 14.3%. Part of the game. Of note, of these 41 time periods, 31 of those, the markets ended in a positive time frame at the end of the year. So
I personally think that's the biggest takeaway from this chart. And I do think this is a very powerful chart to look at pretty much across the board. In any given year, there is at some point where the market is ending up, it's dropping into lower territory.
Yeah.
And it's investors that can basically manage the emotions in those times. Look at the statistics, look at the numbers, that will be able to make the most rational decisions coming out of that.
Yeah. One last chart, Brandon, just to we talked earlier about the markets dropping, but if you have different parts of that market will drop differently. Let's look at a chart that shows asset class returns. And this chart it's a busy chart, but I'm sure most people have seen something similar to this, where it breaks the market down into asset classes. And if we just look, because it's easy, look at the upper left-hand corner, look at REITs. So in 2006, the top performing asset class was REITs. Now, typically what you're going to see is a whole bunch of people piling into REITs, right? Well, in 2007, the worst performing asset class was REITs. And then if we look at 2008, they climbed up, kept climbing in 2009, 10, 11, 12, REITs were at the top. Money is flowing into the REITs. And of course, predictably, you're going to see them dropping down the line at some point after that. Pick the asset class, whatever it is. Nothing is always at the top. Nothing is always at the bottom. I guess be mindful that if you are, and I know there's a lot of people right now who are heavily growth invested.
In particular tech, let's call it.
In particular tech. So when we do see the S&P 500 drop X percentage, the S&P 500 is heavily weighted in the tech companies, the largest mega caps. And so if you have the S&P 500, say, in an ETF, and you own all of the FANG stocks or the tech stocks on top of that, you're putting yourself at considerable risk. Lesson in diversification, just make sure that you have the portfolio properly set up. And really importantly, the time to do that is not when things are happening. Set it up now.
It's prior. I think that's huge. I think people will basically, when their portfolio does drop 30% or 20%, that's when they say, oh crap, well maybe I should be making some changes. But again, it's the proactive investors. It's the ones that are doing this now that are basically taking the risk off the table by making sure they're properly diversified. And I think that's really one of the takeaways today, is that the volatility is going to be there.
It's going to be there.
It's been there, going back as far as data goes. But it's certain investors know how to handle it better, and certain investors have structured their portfolio better to essentially prepare for those periods.
I like what you just said, and that is, I guess, the takeaway. You can't be an equity investor without having volatility. That risk, volatility is going to be there.
Buy a GIC otherwise if you can't handle it.
Buy a GIC, and I mean, heck, there's times over the years where I counseled clients to buy GICs because everybody wants to be an equity investor. Everybody wants to make more money, but if it's not, sometimes it's not in your nature. One last chart to look at here, and I love this chart. I've been looking at it for a couple of decades probably now, something similar to this. It shows the range of stock, bond, and blended total returns over a 1-year, 5-year, or 10-year, or 20-year rolling periods. And let's just look at the green. The green is representing stocks. And in any one time period, and the way I would explain this to clients is if you invest today in a stock or in the stock market, what can you expect to happen? And you kind of set your expectations anywhere from a high of 47% to a low of 30, a loss of 39% in that one time period. If you look at, okay, well, what if I buy today and hold for 5 years? Using historic data, the best 5-year rolling return has been 28%. The lowest has been -3. So yeah, you don't want to sit there with a negative 3% return over 5 years, but it kind of puts in perspective if you do have a bit of a time frame, the downside risk is so much less. And then if you look here at a 10-year rolling period, again, high of 19, low of 1. And if you stretch that right out to 20, and probably most people watching this video will have a minimum of a 20-year time period, I would hope, 17 compounded and a low of 6. And so on the right-hand side of the chart, you can see how the gap narrows so dramatically. And we always talk about long-term investing, or what is your investment horizon, your time horizon. And if you have a 1 or 2 or 3 year time horizon, it's very, very unpredictable. I don't care how good you are at doing your due diligence, how good you are at analyzing. If we think back to February of last year, I remember we did a video, and one of the topics was the likelihood of a recession occurring. And I remember saying, gee, I looked at all of the metrics I look at, and they're not there right now. I think things are still good. Well, they don't have COVID, they don't have pandemic in the typical metrics that you look at. So even though you're careful and do things that you should do, you have to prepare for something like this. But they're going to happen in the short term, and we've already seen, so the effects of that kind of not behind us, but we're working our way through them quite well.
So if I'm hearing everything right, I think I can summarize with just a few quick points to wrap up this video. I think what hopefully we're displaying to you guys is that volatility is normal.
Yes.
Volatility is to be expected.
Yes.
Crashes are normal.
Yes.
Corrections are normal. These 2-3% drops on an intraday basis or on a given day basis, that is completely normal. And how to handle that is, first of all, educate yourself on what the markets do, how they behave, how they react.
I would say, understand what path you're on. You understand. And
that's a good one.
Most important, don't wing it. Have your plan. Don't just start willy-nilly throwing things out there, then adjusting after the fact. Just have that plan, stick to the plan, understand what you're doing. And as long as you have the mind for investing, you will be fine. But it can be uncomfortable. Heck, even the most seasoned investor, you feel uncomfortable when the markets are going through these huge gyrations, but you do learn to live with it.
And I wouldn't say live with it. I'd even take it a step further and say with the proper education and the proper knowledge, you tend to actually like these and invite these opportunities because, again, to just throw up a couple of these charts, if you have that time frame on your side, if you have that long-term horizon, if you're not going to hit the panic button and when things go south, you realize that these volatilities that we're seeing and these drops in the market are nothing less than opportunities when you're looking at great quality investments and great quality stocks. Very
good point. And when the markets do pull back, it truly does provide the opportunity to increase returns. I mean, it's fine to own an index and go ride the ups and downs, but if you can add during these times with that extra cash you've got on the side, very good point. In fact, that's really the only opportunity to beat the market is to be able to take advantage of the gyrations as opposed to just ride it out.
That's so true. But hey, I think we can wrap up the video there. Hopefully this video was able to give some of you guys just a peace of mind, just some of the information, some of the statistics. And if you did find that that helped, again, we'd really appreciate it if you dropped a quick thumbs up. If you're not already subscribed to the channel, we post videos like this every week. And now that you're back, hopefully we'll try to get a couple videos done at least before you're back out of here. But yeah, it's just great. It's just all great that you're here, I'd say.
Yeah, it's so nice to be back here. And so for those of you who are maybe new to the channel, I don't live in Vancouver. I live in Powell River, BC. And so, and because of the pandemic and travel restrictions and everything else,
it's just been tough.
It's been 7 months since I've been back here in my former office, now the Investing Academy head office. So yeah, but it's great. So wish we could do this more often.
Well, hey, if you want to see more content, make sure you subscribe. And last but not least, we do have our Investing Academy. So for anybody that is new to the market or you just want to increase your knowledge wherever that is, we do of course offer courses and training for Canadians, strictly based for Canadians. All video can be done online from the comfort of your home. There's a link down in the description where you can click that and check it all out. But I guess as always, we can wrap up there.
Yep.
We thank you guys for watching. We hope you enjoyed, and we'll see you in the next video.